I just want to highlight one thing again, in case you missed it. What Stuart said is that when you have a sale of the stock of a company, you you're in a situation where you could pretty much exclude up to $10 million of the gain. So so that's a significant tax saving. So really want to make sure you guys heard that one.
Startups with Stu is a podcast for anyone living or wanting to live the startup life, either as a founder or a team member. Your host, Stuart Draper, was a 9-time Inc. 5000 honoree before age 40. This show dives deep into the exhilarating world of entrepreneurship with guests that are seeking advice from Stu for their startup or business owners that want to share their entrepreneurial journey. Listeners always walk away with actionable ideas of what to do to take their startup to the moon. Startup life can feel like a roller coaster ride. And with Startups with Stu, you're likely to turn your roller coaster ride into a rocket ship ride. Get ready to uncover the secrets to startup success from visionary founders and savvy investors who've transformed groundbreaking ideas into thriving ventures.
One of the reasons I do my show is because I want to help founders and people that like to invest in founders. I'm trying to create a community that is the ideal community for what I needed 10, 15 years ago. As a young founder, it is hard to find the right mentors and money. And so what I've put together with Startups with Stu is a lot of great content that will help you. And for free, you can always come and listen to the Startups with Stu podcast. I hope you know that. I want to invite those that are listening, whether you be an angel investor, a VC, a private equity guy, whether you are a founder that's bootstrapping or a founder that's raising money, or a founder or a small business owner that's already kind of like figured some things out, but it's kind of stuck in a rut. I want to invite you to my Startups with Stu retreats. These are paid events. You have to apply to attend. Not everyone gets in, but they are a blast. First and foremost, we have fun. And second, they are game changer for your business. They are worth the investment to attend. Go to startupswithstu.com/retreats, or just go to startupswithstu.com and find the retreats tab and learn more. Apply and see if we can get you into the next retreat. We have one coming up August 20th through the 22nd and another one coming up September 8th through the 10th. So if you're into the outdoors, especially this is for you. We're in Island Park, Idaho. It's right by Yellowstone National Park. You spend some extra days, go to Jackson, take a break from the day-to-day grind. In the book Walk Away Wealthy, Mark Tepper says that every founder should be taking 2 weeks off, stepping away from the business so they can see where they need to go work on the business so that they don't have to be in it all the time. Come and attend. Look forward to seeing you there. So if you haven't yet, go to startupswithstu.com, find the retreats tab, go learn more, and apply. You got 2 opportunities. Come and join us. Welcome to another episode of Startups with Stu. This week we have with us Mr. Richard Levychin of Galleros Robinson, an M&A, taxation, finance, accounting type firm that can help you and entrepreneurs save millions. Okay. And I'm excited for this episode for those that that someday will go, wow, years ago I listened to an episode of Stu and Richard, and it allowed me to prepare myself for this payday today, years later. Okay. This content that you're going to get today could literally save you millions. And it did in my case, this type of information that so few get. So Richard, welcome to the show. Thanks for joining us today.
Hey, Stuart, thanks so much for having me. Appreciate it.
Yeah. Richard, so tell us, what do you do today for Galleros Robinson?
So, quick 2-minute commercial on Galleros Robinson. Galleros Robinson, we're a CPA and advisory firm, and we're about 100 people. Offices New York City, New Jersey, Florida, Chicago, and the Philippines. And I am partner in charge of the New York City office. I run the firm's private sector practice, where I work with privately and publicly held companies and high net worth individuals. One of my areas of focus is what we call the emerging business market, which is made up of fast growth companies that are growing both organically and through mergers and acquisitions. And we advise them through the process, take care of all their tax needs, that not only tax preparation needs, tax compliance needs, but also tax mitigation. We bring them out of tax mitigation work and any kind of financial reporting, but a ton of client advisory services as it relates to M&A, which is the area that I think we're going to be talking a lot about today.
So, folks, if you just fell asleep or your eyes glazed over listening to that, you're normal. That's okay. We need the Richards of the world and firms like them who can help founders know and understand this very critical information. And one of the reasons that I think a lot of founders get snoozy, bored fast around this information is because they don't need the information all the time. But when it matters most, they wish they had paid attention. Isn't that right, Richard?
Absolutely. Yeah, absolutely right. And I think the way that you can think about our clients is that we send out a weekly newsletter. So a lot of times, and I think you actually shared the same thing, a lot of times you'll get a topic that you're just not up to reading yet. But it'll be, the topic will remain in the back of your mind, and it may become relevant to you a year or so later, and you'll go back and try to find that article. Yes, a lot of times, a lot of situations as you're growing a company, you get involved with situations that there's significant tax saving opportunities or better ways of structuring deals. And it's important that you be part of a firm that can be a resource in terms of getting you there.
Yes, absolutely. Folks, I found Richard through his newsletter. Every week he sends out, and he's like clockwork religious about this. He sends out very helpful information. Do I open each and every email? No, but occasionally I get a headline that I'm like, oh, that applies to me right now. I need that information right now. And I'm glad to be subscribed, even though I don't open every email, because when I see something that's going to help me with my business, then I tune in, I pay attention, and he has been very helpful in the type of information that he's sharing. Every founder should be paying attention, especially if you're in a stage of growth or getting to a place where you may actually sell your business. So if you haven't, go to Galleros Robinson. I'm going to screen share this tab. You can go check out their website, and I hope that you'll go and subscribe. The information here could save you millions. So,
I just want to add one thing, Stuart. If you look, you'll see they're aligned in Knowledge Center. So if you go to the Knowledge Center, every single newsletter that we've sent out since the beginning of time is sitting in that Knowledge Center. And the Knowledge Center actually has a search bar. So if a situation comes up, a critical situation comes up in your company, you may need some information on, just go to our Knowledge Center and just in the search bar, just type in a topic, S-Corporations, LLCs, whatever. And chances are there'll be an article on there. What we strive to do is to write our articles in English.
Yeah, I think you've done a really good job of specifically that. So I'm going to type in here just for fun, Delaware C-Corporation. And when I do, I bet there's some information around Delaware C's. And I may have not spelled it in a way that'll find it, but we will quickly find information. While this is pulling up, let me explain, you guys. I did a search that's not going to find it.
You just kicked out, yeah. May have to. You know what? Why don't you just type in S-Corporation? Once you type in qualified small business stock.
Okay, there you go.
S-Corporation. There's a bunch of stuff there on S-Corporations.
Qualified small business stock is one of the important terms I want you to remember. It's also known as QSBS. This term matters, folks. When you qualify for small business stock, there is an exclusion, okay, where you don't have to pay taxes on the first $10 million or 10 times the adjusted basis of the stock sold per shareholder per corporation. So when I said it can save you millions, it really can, but you have to be set up for success. And in my case, in 2013, it would have been, 2013, we started raising money for Stuart. And the founding legal team that I used, he came to me and he's like, "Hey, I think we want to set you up as a Delaware C-Corporation." And I was like, "No, thanks, man. I'm in Idaho. Why would I get that complicated with this thing?" He's like, "Well, do you think this thing's going to go to the moon? And do you want to do what's right for your investors?" And I was like, "Okay, yes, I want those things. So tell me more." And he's like, "Well, if you do this and you set this up right, it's the most tax friendly and beneficial form for a business that's raising money. And by the way, you don't have to raise money in order for this to benefit you, but it does help, especially if you're raising money. And a lot of investors will ask you to become it if you're not that when they go to give you money." And Richard, assuming a founder has gotten down the road, they've raised money already, they're still an LLC or an S-Corp, can they transition to a C-Corp?
Yeah, and I just want to highlight one thing again, in case you missed it. What Stuart said is that when you have a sale of the stock of a company, you're in a situation where you could pretty much exclude up to $10 million of the gain. So that's a significant tax saving. So really want to make sure you guys heard that one. Now, one of the things is that of course, there's always a catch to this stuff. One of the catches is that you have to be a C corporation, and there's other tests like your asset base must not be more than $50 million, and then there has to be original issue stock, and then you have to hold on to the stock for 5 years. And there are certain industries that can't participate. So if you're in the service industry, you can't participate. But let's assume that you qualify, except for the fact that you're not a C corp. If you were in a typical business, you probably formed as an LLC or an S corporation. There's a way that you can actually convert the LLC and the S corporation into a qualified small business, so it will qualify for this 1202 exclusion. We're not going to go into the details of how that works. It's kind of it's fairly sophisticated, and quite honestly, it does require our engaging a tax attorney to get it done. But yeah, there is a way, assuming you have proper legal tax advice, they can help you qualify if you're as the C corporation that's a qualified small business subject to this 1202 if you're an S corp or LLC.
So if let's say that I want to participate, you tell me, yes, your business qualifies for the qualified small business stock section 1202 tax code. Okay, I want to change. Is it effective from that day forward, and I have to count for 5 years into the future, or can the timing clock be started backwards?
No, it starts on the day you qualify. So if you're an LLC, you don't qualify on January 1, and then you sprinkle some magic dust on you, and then June 1st you qualify. The clock starts on June 1st. And as long as you sell your stock after the 5-year period beyond June 1st, then you can qualify for this potential exclusion of up to $10 million of capital gains.
Okay, gotcha. So folks, I was so glad that I had a good accountant, a good attorney that helped me early days with the fundraising of Stuart. They helped me file with the SEC and do things the right way. And get this, Stuart raised 3 rounds of funding. We raised money in year 1, year 2, and year 3. It was just over 8 years later that we sold our shares, a lot of our shares, to a private equity group. It had been the last people that gave me money to grow Stuart. It had been just over 5 years by like 1 month when we did the deal. So literally every investor in Stuart was able to participate with this qualified small business stock. And I'm sure there's a listener or two out there going, this seems shady, or this seems like unfair. What a crazy tax loophole. How do these guys that make all this money get away with it? And why does both Republican and Democratic government leaders, why have they all chosen to keep this qualified small business stock? Do you want to share, Richard, your theory with us on that?
Well, at the end of the day, a lot of these this particular tax mitigation strategy is a job creation act, in the sense that what it does is it's a way of encouraging investors to invest into a qualified company in exchange for a significant tax write-off.
Mm-hmm.
Now, the thing is that there are certain rules around who can't participate. So if you're in the professional services business or the financial services, even if you're a C Corp, you still don't qualify. So that pretty much a lot of it is manufacturing companies. There's a big push under the current administration to increase manufacturing in the United States. So the companies that they'll look at are in industries that they're looking to expand and grow. And it really is a job creation act.
Yeah. I like that explanation and description. It's a job creation act. The focus here for the political leaders that have made these choices to include this benefit, they're doing it because they know that if people are investing in startups, those startups can grow and hire talent and create more jobs in the USA. So for that reason, I think it's a fantastic incentive. And by the way, you don't qualify unless you hold for 5 years. So you can't be in and out of a transaction fast and just taking back out your money. You have to let it go to work and stay at work for 5 years in order to qualify. So there are a lot of stipulations to it, but for those that qualify, you're crazy not to have taken advantage of the talent of a firm like Galleros Robinson, who can help you think this stuff through. So,
and again, if you want to find out more about the qualified small business stock, you can go to our website, go to the Knowledge Center, and you can just type in qualified small business stock, or you can just type in the numbers 1202, which is the IRS code section it sits in. And you'll see a whole bunch of articles written in English. And that way you can kind of go through them and get a really good sense of what's needed. And here's the other thing I want to say to you is, if you think you qualify, you need to also have a tax person double check to see that you qualify. Because we actually had a client that thought they qualified and they actually didn't. And they were teeing up for an exit. And when, we got to explain to them that no, they hadn't done the qualifications properly. And we got them halfway.
Right. Yeah. You would have set them up for success. You would have helped them understand had they been your client sooner. Folks, if you haven't yet, take a second, go to startupswithstu.com and learn about my upcoming retreats. I have Rudy Rudiger coming. I'm so excited. Rudy is the guy that, if you've ever heard of the movie Rudy, it's a football movie, a story of an underdog, and founders, frankly, more often than not, you will find yourself as the underdog. Cannot wait for you to get to hear from Rudy. If you go to startupswithstu.com/retreats, you can learn more about the upcoming events and go and apply. Folks, this is an investment in time and money that's worth it. You will not regret having spent time in Island Park, Idaho with me, yours truly, Stuart Draper, Rudy Rudiger, and other founders and investors that will be there. Okay, sorry for the interruption. Let's get you back to the show now. What was the payday opportunity that they ended up having? Not worrying about the tax numbers. What was the payday valuation they were there?
Ultimately, they ended up not doing the deal because what made the deal attractive was qualifying for the 1202.
Right, because it's so much the actual amount of dollars that you don't get out of the transaction are so great.
Yeah. So the money that would have been that they were now going to be left on the table made the deal not attractive. However, there's been changes to right now kicking around in the Senate is some proposed changes to this, where they potentially could be reducing the holding period and a lot of different things to make even more and have other entities other than the current entities be eligible. So there's some stuff going on around in the Senate right now. I would that is actually we actually have an article coming out probably next week, which is going to talk about what the Senate is, how the Senate has changed some of is proposing to the Republicans are proposing to change the QSBS law to make it even more attractive, and that's coming out I think next week. Our feeling is that when the final bill is signed, these changes will remain intact.
Right now, so I believe that under Obama and Trump, it stayed at 100% tax exclusion on the first $10 million of shares.
That's correct.
But then under Biden, it went back down to 50% from where it had been, I don't know, a decade or two ago. It was at 50%. It went up to 100%. Where does it sit today? Is it a 50% now?
It's still at 100. But the thing is that what we need to focus on is what it's going to become. And
right.
That's going to be decided. The good news on that is it's going to be decided in the next 30 days.
Okay, we'll know where it sits in the next 30 days.
And I think if you go to our knowledge center, there's an article that's going to be coming out next week, but it's already on our website, which has the current version of how it's going to end, how it's going to the final what the promotion is going to look like, and we're betting that that's where it's going to end up landing.
Do you like the changes?
Yeah, I mean it's more beneficial, but the thing is that I think it's best if we direct people to the website. The other thing, Stuart, is that while 1202 is great, not everybody's going to qualify, even with engaging counsel to do all these conversions, whatever. The conversions may not be in a timely fashion. So at the end of the day, everybody listening on to him, relatively, I would say under a third of the people would qualify. So it would be, there are other tax mitigation strategies that can be used towards capital gains that you may want to take a look at if you don't qualify for 1202.
Have you seen some examples where someone didn't qualify for 1202? Maybe you can share one with us without getting into too many of the details, where someone really benefited from your tax mitigation strategies at like an enormous level.
Yeah, we had a situation with a client that had invested $100,000 into a deal, and confidentially, just off to the side, I actually shared this with Stuart earlier. I think it's the one he really wants me to. This is the story he really wants me to tell. So I'm going to go ahead and tell it. So we had a client invested. I'm usually around approximately $100,000 into the deal, and some time passed, and there was a liquidating event, and they called him to say there's a liquidating event, and then they sent them a check for $9 million.
$100,000 turns into $9 million, folks. Those stories of startup investments blow my mind. So he was early days angel investor.
He had an $8.9 million capital gain. So after recovering from 6 weeks of nonstop partying, he woke up to say, I don't want to pay taxes on $8.1 million. I just don't want to. So he had engaged another professional who had put together this sophisticated tax mitigation strategy that involved a whole bunch of trusts and insurance products. And when he came to us, we took a look at it and says, yeah, it's a great strategy if you want to go to jail. So ultimately, we kind of pointed him in a different direction, and we were able to legitimately bring the net capital gain down to under $1 million.
My goodness. So the details of how you make something like that happen, those are unique and individual situations that basically it's not even that helpful to share what you did, because what worked for him won't work for everyone. But the message that I would share with you folks, if you're listening in, is go and find the people that really know the strategies and tactics to help you be able to keep as much of the winnings that you've earned as you can. Because that is money you can put back to work in $100,000 investments in other startups. And heaven knows there are founders out there listening to this going, yes, please don't just put it all in another apartment complex investment where you're going to earn 8% guaranteed. Like, go and help a few founders with some of this winnings that you're getting and be able to do so because you participated in some smart and wise tax strategies.
Now, what I will say to you is this, now, and I'll be real brief. There's multiple layers of tax mitigation strategies. The first layer is stuff that's pretty much 100% bulletproof from an audit standpoint. So the risk on that is zero. And then you got the next layer, which are aggressive positions that you can take that are fully papered up, have tax supporting document, tax opinion documents by large firms. But they're sophisticated, and the IRS will take a look at it. And what we do as a firm is that once you understand the tax mitigation strategy, we then start talking about risk. We qualify the risk for you. So we actually explain where the areas of risk are. And then we quantify it on a scale of 1 to 10, where 0 is you're going to jail and 10 is you're good to go. So we'll give you a rating. So for example, on a particular deal, we may say on a scale of 1 to 10, that's a 7. So at the very least, you won't get seduced by the great benefits of the tax mitigation strategy. You'll also be mindful of the risk. You'll have a qualified, a quantitative opinion and a qualitative opinion, and then you can make a decision. It's the same thing when you're making an investment in one of Stuart's companies. You want to know what the risk factors are. So it's the same thing. If a lot of people look at that get involved with transactions like these where they're constantly selling. Someone like Stuart, who's a serial entrepreneur, but with an exit plan. They want to know, hey, listen, I don't want to pay tons of taxes on this, but what's my risk potential of being audited if I take this on? So it's important that you know the risk factors in terms of whatever tax mitigation strategies that are put in front of you, and that whatever's put in front of you is put in front of you by reputable individuals. The thing about my client, the transaction that was put in front of him was garbage. He was in big trouble with that. But we were able to put something in front of him that was aggressive, and it had a risk factor that he was comfortable with, and that's fit within his risk profile.
Mm-hmm. So, Richard, you've been a part of a lot of M&A transactions. You've seen the big wins. You've probably also seen some potential big wins fall apart. What are some of the pitfalls you've seen that either founders or buyers fall into that make transactions fall apart and not go through?
I mean, some of the stuff is, look, some stuff you never know whether it's going to work or not. It looks good, like it's going to work. You may be getting in too late when the market for that service or product is no longer there. It's real easy to be the Monday morning quarterback and go, oh, you shouldn't have done. Yeah, okay, fine. But at that time, it may be great. So we have to take those off the table because there's no way of knowing. In essence, you really, it all comes down to the quality of due diligence. And founders need to not be seduced by the deal. You need to go into every deal with a certain level of skepticism, optimism, and skepticism at the same time. And you need to have a solid group of people advising you the project and looking where the holes are and where the potential holes are. You need to do great due diligence. You need to have a proper valuation done. You need to do an aggressive quality of earnings. You make sure that the quality of the earnings is there. You need to do UCC searches, check for liabilities, the whole 9 yards, trademarks. There's a whole slew and list of exhaustive things that need to be done from a due diligence standpoint before you should move forward in the deal. But the net, in my opinion, is that, look, you got to have great advisors around you. Yes, you're an entrepreneur. Of course, you're going to be excited by the deal, but then you have to have a healthy amount of skepticism. Now, I know it's going to be very hard to, you get a date with Jennifer Lopez to be skeptical that it may not go right, but you got to be skeptical even with Jennifer. We're hopeful that's going to be great, but go in with a certain amount of skepticism.
Absolutely. Yeah, I like that, setting expectations in advance that, hey, this might fall through and you don't want to get too emotionally attached to a potential deal. If for those founders listening in, he mentioned due diligence and the importance of that stage. If you don't have a good financial team on your staff, if you don't have a CFO that's been there and done that with the transaction, you will probably leave money on the table simply because they didn't do a good job of packaging the right data and information to help the buyer see the true value that you have created with your hard work over the years. So please take the time and get the help you need. A good investment banker, in my case, I used a group called Vista Point Advisors. The reason I loved them for my transaction was they had sold a lot. And when I say a lot, I mean like dozens of education technology businesses over the years. They were very focused in my space. They had potential buyers that they had sold other ed tech businesses to. And they came to us, did a pro bono analysis of our business based on the data that my CFO had created, and said, hey, don't sell this year, wait another year. And in the meantime, while you wait, go get this information. I need really solid information around your cost to acquire customers and your lifetime value of those customers. We're going to create the data in this data room. We're going to build this up over the course of a year. And then it was over the course of 4 or 5 months that we actually went to market to sell shares in our business. And that data room was solid. Everyone that was interested in buying could quickly go and get all the information they needed to see how truly solid our business was. And your financial team, they can't make your business better. They can't put lipstick on a pig. But if you have a good business, they can take a really beautiful woman and put some makeup on her, and all of a sudden she's even prettier, right? And so that's just, a poor example on my part, but you get the point, right? And teams like Galleros Robinson can do the same for you. Highly recommend that you go get someone as smart as Richard to work with you. So Richard, if they want to reach out, GallerosRobinson.com, is that where they go?
That's the website. On the website, my bio is there along with my contact information.
And they can find you on LinkedIn as well,
Absolutely.
Richard Levychin.
Yep. And also, feel free to go to our knowledge center and just type in any topic. I'm sure we'll just going for our knowledge center. You'll be able to get a lot of answers to your questions.
Okay, folks, don't hesitate to reach out. Richard's here for you. At a minimum, if you're like, I don't need this information today, or I don't need to decide who I'm working with today, go and subscribe to the newsletter. I found it helpful and really great information there. Richard's based out of, are you in the New York office? Which office are you out of, Richard?
Yeah, I'm out of the New York City office. I was in our Florida offices yesterday, but today I'm in our New York City office.
Hey, that's a good place to go visit come like January and February, right? That's when it's time to take the business trips down south.
Yeah.
All right.
Absolutely.
Hey,
one other thing I want to say about our firm in terms of those of you that are in the M&A game, we're also in the M&A game. We've grown our firm both organically and through acquisition. So, the stuff that we're teaching, we're actually living and breathing it every day.
Oh, you've done M&A where you acquired other firms like yours.
That's correct. So I joined the firm in October 2018, and we've done a minimum of one deal a year since I've joined the firm.
Okay.
Deal a year.
And then you're representing a lot of other M&A transactions every year for other clients. But you're talking, when you say one a year, you're talking about your actual acquisitions where you guys are buying another firm.
That is correct.
Fantastic. At Startups with Stu, we talk about what it takes to take your startup to the moon. And we are here today having talked about what you do to be prepared when you get to the moon. Don't forget to plan ahead so that you can enjoy the benefits of the knowledge that Richard Levychin and Galleros Robinson have for you. So, Richard, thank you so much for being with us today. I hope that founders listening in have found this helpful, and I'm sure they will.
Stuart, appreciate you having me on.
One last time as we wrap up this episode of Startups with Stu, I hope that you've taken a second and gone to startupswithstu.com. If you haven't yet, go check out the website, make sure you're subscribed to the email, and make sure that you check out my retreats that are coming up. August 20th through the 22nd, September 8th through the 10th. We would absolutely love to have you guys there. You won't regret this experience. The testimonials are amazing. Go check those out and listen to those. In fact, I'll hit play on those next.
This is the best networking opportunity I've had this year. I would gladly pay whatever the cost it is to come year after year. Just with the people I've met, the motivation that it gives you, the skills that you take away, the connections that you get, you have lifelong friends here. Like the wealth of knowledge that I've been able to gain from very successful people in a wide variety of industries has been fundamental, I think, to my perception of what good business looks like.
I for sure have 2, 3, 4 people that will have a direct impact in my business and in my life right away. We just connected. It probably will leapfrog my business.
I came to Stu's Entrepreneur Retreat because I wanted to build a network that will help my business and help myself to grow. I gained connections that would not just last for a minute or a month, but for a lifetime. I came into this thinking, you know what, I'm not worthy to be here. And I left feeling like I was.
Being around guys that have broken past what they thought their ceiling was, and to be able to think bigger and really just go for it, right? And that for me was really transformational this weekend. To be able to kind of shift a mindset that I've needed to do and kind of clear the fog of where I need to go.
I've enjoyed getting to meet people and been able to elevate my thinking into trying to become a better version of myself. And that's really what this whole thing is about, is trying to get people to grow and become better versions of themselves so that they can help their community, their businesses, and their family.
The various speakers and the attendees have been very impactful in my life. The clarity that we've received up here and the inspiration to be not just a better businessman, but to be a better human being.
Thanks for joining me on Startups with Stu. We have big goals to help millions of entrepreneurs. If you enjoyed this show, please take a minute to share it with someone else that needs to hear it, or leave a review. Remember, success is within reach for those who dare to dream big and take action. Until next time, keep pushing forward on your entrepreneurial journey.